How do you get a D2C business to look like a SaaS business? Learnings from buying and selling multiple e-commerce businesses? How can you get memberships to make your CAC math work? And what's next for this 8-figure beauty brand? Welcome to In the Money, an exploration of whether you can still make money in D2C and CPG. We followed the flow of money between founders, investors, lenders, and everyone else in the ecosystem to ultimately answer the question, is D2C and CPG still a good business? Today, we have David Recook on the show. He runs Bamboo Earth, a skincare brand, which after their acquisition by Dave's group, has grown more than 30 times. Hope you'll enjoy the show. Dave, no warm-ups here. We're going to go straight into hot takes. Membership programs. I think we were talking about before recording that we think like maybe less than 1%, definitely less than 3% of all Shopify brands probably run membership programs. This is not an ad for your vendor, but you can make it one if you want it to be. You offer membership services at Bamboo Earth, I think 15% off from what I could see from the site. You've published some of your results publicly. Share your learnings, please.
Yeah. Happy to jump right into the hot take here. So yeah, for me, what attracted me to the membership idea is increasing our revenue quality. So we had kind of hit a little bit of a wall, some user friction with product subscription. And so in the skincare cosmetic space, one issue is that it's not quite as predictable as like how much you're using compared to something like maybe deodorant, or compared to something like, you know, you're regularly using protein, or you're regularly consuming like, I don't know, soda or water, whatever. It's less predictable that you're going to run out of this in 30 days, 60 days, 90 days, whatever the cadence is. As an example, just people use more moisturizer in the winter than they do in the summer. So there you have just a very seasonal example that they might want it every 6 weeks in the winter and might only want it every 3 to 4 months, in the warmer months. And so from our side, though, what I really want is a commitment from our users that like I'm committing to a higher level of revenue quality. I'm making some form of a commitment to you in exchange for that discount. And so, we had product subs at 10% discount, and I played with a bunch of different styles on this. I actually A/B tested it up front. So I have some pretty rare data here that I A/B tested it strictly in acquisition, and I had a membership exposed cohort and a membership, they never saw it. They had no concept of it. And so that could control for the idea of like self-selecting your best customers into that sort of thing. And we did see an LTV bump in the first 90 days for those that were even shown the cohort, never mind those that opted in. And so for us, it works well they give us a form of a commitment, which is $40 every single month. They get it right back in terms of a credit. I let them, those credits last for a year. So they're effectively, no real limit because people are using them enough. And I get, and in exchange, I get $40 every single month from those members, like clockwork. And it has continued to grow over the, 18, 20 months that we've had it implemented. And it just, it's still growing month over month. It's our overall total subscription revenue has nearly doubled since implementing the program. So it did cannibalize some of the other forms a little bit, but it definitely lifted the total ceiling on, total recurring subscription revenue.
And just to play it back, members pay $40, they get the equivalent dollars in credits, and they also get 15% off. So are they getting whatever that math is?
Yeah, exactly. So the credits come back exact dollar amount, but as long as they're logged into their membership or use their email and checkout, it automatically knocks 15% off their order.
And you're saying that even the ones, so not specifically just the ones that are not just the take rate, but even the ones that see that it's created some anchoring of I'm going to be around for a longer period.
Yeah, I think that my theory is less on something like the anchoring and more on whenever you analyze something like a membership program, the vendors out there come in and say, look, your members are worth 3 times the amount of your normal customer. And the rebuttal to that is, yeah, my best customers are obviously going to take advantage of the membership. So there's self-selection in the data. What I believe to be true is that I'm getting about, say, 15 to 20% opting into this membership program. And their additional value is able to take the entire cohort and move it up in terms of a lifetime value. So they are legitimately more valuable because they're opting into the program. And that's my way to control for that.
When we had considered membership programs in the past, I think we tried to maybe play too many games and add too many bells and whistles. It sounds like for Bamboo Earth, it's just financial. Like there's no points, there's no birthdays, there's no BOGOs.
No. And I've played with I have given some, they have access to some sales and exclusivity, and I've played with them even getting some product in advance. And that's certainly a lever that you can pull. But I actually played with more complicated structures, and I had more customer service problems. So in the beginning when I was testing, because I was testing it just exclusively against a new cohort, I'd get a couple hundred signups. It was easier for me to discard it and move on and change the program details. So it was easier for me to try on multiple things compared to somebody that rolls it out like a loyalty program and just goes to their whole customer base. It's a lot harder to take several thousand good paying customers and tell them this thing's no longer around. Now go memorize these new details. So kind of the way I implemented it was in a very sort of discovery fashion. And I found that a simple, straightforward commitment as well as benefit was, received the best.
What I want to tell you about today is Parker credit cards. Look, there are multiple subreddits dedicated to credit cards, points hacking, and cashback, and I get that. But what do entrepreneurs really want in today's market? Helping managing their payback windows when acquisition starts ramping. With Parker credit cards, you get up to 90-day repayments on ad spend, so helping you on your cash conversion rather than having all that upfront ad spend before revenue starts coming in. Parker allows you to spend aggressively while still managing cash flow, including meta spend. So instead of hunting for best points or cashback programs, realize that the best ROI is to be able to increase your ad spend without hurting cash flow. Go and check them out. Parker credit cards at getparker.com. Parker is a financial technology company, not a bank. The Parker Commercial Credit MasterCard is issued by Patriot Bank N.A., member of FDIC, pursuant to license by MasterCard International Incorporated. I'm just curious now, is your take rate higher at acquisition or once they're already a customer?
Definitely once they're already a customer, it's higher. But it has a surprising amount on acquisition. I'd say 12 to 15% of everybody who comes in as a new customer will just take it. And part of them look at it. So I also structure it so the very first order there's no charge. It's only a charge on the $40 recurring. So people are definitely getting that 15% on the first order. However, the churn rates are not I'd maintain 80+%, every month, retained.
Yeah. And given that sounds like you're also almost offering everyone a 15% discount, is there any other kind of promo activity that happens through the life cycle, or that's kind of it and you kind of just fixed it there?
No, because I look at us as a small to mid catalog brand. And the way I usually approach pricing and promotions and stuff is first I think of what's the behavior of that industry, and then what size is my catalog. And so if I were 1,000 SKU brand, I think that the way I'd have to approach it would be very different. But as a small to mid-size catalog brand, so as an example, we produce 20 to 30 total products. And then I can bundle them into, a variety of different configurations or sizes or what have you. But so it's ultimately up to me to, let's say 20 is my core, right? So it's up to me to figure out how can I most efficiently sell these 20 things to people again and again and again. And so I have what I would say is a rather manual hand in that, in terms of all right, let's put this bundle together and this is what I'm going to recommend to them, and it's this price. So I have a very hands-on shaping of the unit economics of that. And so because of that, I'm able to, okay, here's a completely free gift. It's $100 value. Wow. And so it'll be a big discount, but I've shaped things in a way that it's a great, contribution margin or gross margin, for us.
Yeah. And just to stick with the kind of customer journey, I think on the site you send most, if not all, of your traffic through a quiz. Maybe talk us through that funnel.
Yeah, for sure. And so I use Octane for that. And by the way, the vendor I use for the membership, since I talk so much about them, is Inveterate, and I feel obligated to give Dylan a shout out. But we use Octane on the quiz. We actually started with a type form quiz, just a very like basic. We used it so much that we actually hit like all sorts of limits on it, and needed to upgrade to an enterprise. And that's when we just said, okay, let's go all in on this concept with Octane. And so, yeah, it's been something that's a prime example of people come to me looking for one thing, and I'm able to guide them into sort of a wider set of items. And that's almost always a challenge in e-commerce. And the way I frame this when I explain it to people is that I think that the cost structure has a very different look than the value structure or perceived value structure for a customer. And by that, I mean, customer comes in and they value one little jar of $30 at $30, and they expect to go buy it at $30. And you go, yeah, but pick, pack shipping, one little jar of $30, that kind of sucks. Like a large percentage of my COGS is the pick, pack, ship. It's payment processing, it's the shipping. So it's really a poor alignment of these two structures, the cost structure and the value structure. And so that, I really think that's the sort of thing that in any walk in business, you need to be constantly thinking about that cost structure versus the value structure, and when they're way out of whack. If you're selling through Costco, you have one cost structure and value structure. And if you're selling through ShopRite or Nordstrom, and if you're selling online, you have a totally different one. And so the quiz to me really helps align that. And actually, so I think there's two key components about the quiz. Is one, I'm able to shape that structure via like bundles and a very like I call it on the rails offer, where it's like, here's your offer, take it or don't. And then the other part of it that is a value creator is if you're in an industry where there's a paid cast of professionals that help you find the right product, then that's a pretty good industry where you can automate that logic of finding the right product and provide it to them and provide value. And so there's a paid cast of professionals, which are estheticians and dermatologists that help you find what skincare is right for you. There's genuine mystery there. I mean, the same might even be said of, a personal fashion or stylist. Same can definitely be said of makeup and hair. And so when there's this cast of professionals that generally help you do that, if you can find ways to automate that logic, then you're providing real value. Because people do value and pay for that sort of a service. So I think it's those two unique things about both my offering and my product that make it such a compelling, on-ramp for my customers.
There is definitely a school of belief, and maybe the default school in performance marketing is like, the fewer clicks to check out, the better. And this is elongating the funnel, asking them to do more work. Help me overcome that hesitancy.
Yeah. I call it good friction. Whenever people talk to me. So yeah, I think that like if you're going to a like lowest friction model, you would just sell on Amazon. And so like all of us that host the DTC site believe in some level of friction, whether we want to like explicitly say that or not, because like if we didn't, we would just host it on Amazon and point the ads to Amazon. Right. Cause they obviously are the best in the world at lowest friction. And so you have to believe in some form of a good friction in order to get there. And so, yeah, I mean, it just comes down to that, is that there are certain forms of friction that are additive, and they believe more and more and more in the product when you put that friction in there. For instance, I've tested things like removing email as a required field, making SMS as a required field. So I've tested both directions in terms of friction. I got the quiz down to like a 45-second quiz with no contact info, pushed them through, and I've tried everything in between. It's probably about a 3-minute and requires an email. And I'll tell you that the revenue of pushing dramatically more people through, I mean, like 2x the number of people through the quiz, did not produce more revenue per session. So there's definitely some good friction in the sense that you're going through. There's some believability to, I've asked good questions that are mapping to the quiz. Then on the quiz side, there needs to be some believability that the inputs match the outputs, and I've been listened to. I mean, the same way that a one-to-one conversation with somebody who's recommending, if you walked into an esthetician they asked you 3 questions and they shoved something at you and said, it's our best seller, take it, you'd be like, thank you. Let me go get another opinion. So you have to maintain that belief that that you're providing something of real value. And so asking good questions, showing good results based on those questions, and maintaining that I don't want to say shroud of believability because I believe in it, but that perception of a well-recommended solution to my problems.
Since you touched on a kind of tight to mid catalog SKU count, I think our mutual friend and your former colleague Taylor has been beating the drum, and in fact, so has that other mutual friend and your former colleague Andrew, both been Andrew Farris beating the drum of product proliferation as a way to grow, especially when there are diminishing returns on acquisition. Maybe speak to that.
Yeah, for sure. I do think that there's a balancing act there, and I think if you talk to Taylor and Andrew both, and you ask them some pointed questions about like working capital and like the cost of carrying, I think they'd also say that you need to be retiring SKUs and putting them to bed. And that I actually think is like, people are generally pack rats and want to hold on to things. And I think that entrepreneurs are really no different. Like we all have our golden projects that we don't want to relinquish. And it was a project you launched 4 years ago, and product you launched 4 years ago. And it's like, by the numbers, it just never justifies, it never justifies itself, yet we have a hard time letting go. And so I think if you talk to both of them, they would say, yes, you need to be launching constantly, but you also need to be killing constantly. And I don't think it's necessarily, a small to mid-sized catalog. I think it's just an advantage that lots of brands have, but don't exercise. Like, I'm not Ulta Beauty. I don't have 100,000 SKUs on my website or 10,000 SKUs on my website, which means that it's way easier to find stuff. And I can index on that side of being ridiculously helpful, ridiculously prescriptive, ridiculously shaping the offers. I cannot offer endless aisles for every single problem ever, with my product set. And so for me, we hired a full-time chemist here, full-time cosmetics chemist, where she's primarily doing new product formulation. So we're pumping out new products, but I'm consistently looking at what am I culling? Sometimes it's improvements in an existing space. Sometimes it's movement into a new space. But ultimately, I don't think anyone's going to advocate for being a mile wide and an inch deep, as far as product is concerned. So you have to get to a reasonable depth. Otherwise, you're not even moving the top line, as intended anyway. So I guess it's a balancing act of having sufficient depth, making sure that the products you do keep around make sense from a financial perspective, but then also getting sufficiently good at bats for new stuff.
Why do we love Numeral? Well, here's the good, the bad, the ugly. The good is that over 1,000 e-commerce store owners just like you use them for sales tax compliance, including some pretty big brands like Ridge, Emmy, Nomad, and Graza. The bad is that none of us got into this to spend a ton of time on sales tax and admin, which is why Numeral is able to help you in 5 minutes or less get full coverage, deal with registrations, ongoing filings, and compliance. It just happens in the background. And the ugly is that not a lot of store owners know that sales tax is actually personally guaranteed. Said another way, that the states could end up coming after you personally if you're not on top of it. Even a modest $5 million store owner could have Nexus in 20 or 30 states. Again, Numeral helps you stay compliant, and they even guarantee their work. That's why we love them. Go and check them out at numeralhq.com. You were a part of a really interesting thesis along with Taylor, along with Andrew, and said, hey, we are world-class performance marketers. We have a world-class performance marketing agency. We make brands millions and tens of millions of dollars. We should capture some of that value. We will do that for our owned brands. You had this experiment, 4x400, bought a number of brands. Ultimately, from what I understand, Bamboo Earth was the one that broke out. You sold some of the other brands. I guess, what were the attributes of Bamboo Earth breaking out?
Yeah, it's a good question. And just so you know, I joined in 2020, Taylor and actually I was not from the CTC. A lot of people don't know this, but I'm from outside there, and I came in 2020 to help them scale a few of their brands. But yeah, so that was, you nailed it. The thesis was essentially acquiring micro brands, with a committed founder, leaving the founder on board and trying to scale what is micro. And I mean, in many cases, I think all cases, sub 100K in revenue, trailing 12 months. And so taking that really small amount of fit and pouring really paid social on it and trying to grow it. And so, at its peak, it had seven total brands. And, first of all, there's a challenge and a complexity, which I think is somewhat well worn at this point. In running a holdco, you're ultimately running 8 total companies, the holdco, and then the individual brands. And the thesis we had from an investment standpoint is obviously flawed. I don't think any of us would go back and do that again. Not precisely anyway. But from the characteristics of the brands and why they struck out, actually Bamboo Earth had a similar top line to another one of our brands, Slick. But from a not just bottom line, but really like all kind of financial attributes or DNA, as well as sort of product market fit. We felt the most strongly about Bamboo Earth, selling, cosmetics online, rather than, heavy fluids, with long lead times out of China and stuff. So yeah, it was kind of the attributes of the brand. And I guess, what a few of those would be is strong gross margins, high repeat rate, for customers. Still to this day, actually over 50% of our revenue is repeat customer revenue, which is high for, direct to consumer businesses. So strong gross margins, really strong landed margins, or, fully delivered margins. The high repeat rate, which is really, really nice, especially if you're going through fluctuations in acquisition. It's manufactured in North Carolina, and, honestly, an attribute that we stumbled into, but now I value very dearly, is, incredible turnover. At points, I've run this brand for maybe a period of 12 months where we were holding maybe 3 weeks of inventory average, and constantly making and shipping just in time to our facility of finished goods. So, it's definitely been running extremely lean on the inventory front before, which means that we're able to realize, not just all of our profits in cash, it's actually in excess, because take our membership program, that's essentially a pre-sale. And so over the last 18 months, we actually realize an excess of cash beyond profits.
Wow.
So yeah.
That's incredible. I don't think I know many, if anyone, in e-commerce that can say that.
But and so it's funny. I just saw people talking about cash conversion cycle and stuff. But like, to me, it's working capital and the management of net working capital. And so I don't try to run it super negative. It's not like I'm trying to, like, the more negative the better. But I am trying to run it in a way where we realize the majority of or entirety of our profits as cash.
Yeah, I was on a group e-commerce networking call with Andrew recently, and there was another investor on there, and we were just talking about some of the breakout brands that people had seen, and naturally you go to beauty and sups, and I wonder if that is one of the learnings of 4x400. You guys kind of had Slick, you had Bamboo Earth, I think you had a pen business, you had the baseball glove wallet business, and I think this is the thing that a lot of people in e-commerce are realizing now, 10 to 15 years in, and which is there are only, like, I shouldn't say there are only a couple that work for e-commerce, but there are definitely a couple of categories, and more specifically attributes, that work much, much better for DTC as a channel. I sometimes say to my kids, unfortunately, if you want to earn a lot of money, there are only a few types of jobs that you can go after. And I wonder if it's the same thing for e-commerce, that there are only a few categories that kind of can make you a lot of money.
Yeah. I do think that to a degree we learned what is the common industry thing now is like, hey, low cost, low product COGS thing that people consume over and over is quite good. It's a good work if you can get it. I would also combat and say like, it's also extremely hard. It's like cutthroat on acquisition comparatively. So they're like, I forget what entrepreneur told me this first, but it's like in business, you just have to choose what kind of hard you want. It's going to be hard. And fortunately, you get a choice. What hard thing do you want to do? And so the hard thing in cosmetics and supplements is acquiring customers and making a product that they'll repeat on. So if you're comfortable with that kind of hard, then that's good. If you go into apparel, I don't know too much about apparel, but I'll tell you one of the hard things has got to be SKU and inventory management. So if you like that kind of hard, that's a good space for you. If you don't, get out, because that's the kind of heart of the space, right?
Yep.
But I do think that is true. That is, generally speaking, a much better fit for direct consumer or digital sales than other industries.
Yep. Beauty also, especially a lot of emerging beauty and cosmetics brands, sit in retail. You guys have had a distribution evolution. I'd love to hear about that.
Yeah, that's a good question. And so it is the sort of thing where we were, for a period of time, we were even shopping Bamboo Earth on the market to see what it was worth. And, we were exploring a sale for a period of time. Since then, we've kind of walked back and we're saying we're going to hold the brand and scale it. And so since that point, honestly, part of what I learned about shopping a brand out and talking to people in M&A is that the attributes of a brand that people look for in acquisitions generally also just build good, stable businesses. And that's why they look for them. Right. And so like revenue quality is something where like the gold standard of revenue quality is like annually recurring, AAR for B2B, right? Like that would, B2B, ERP, annually recurring, multi-year
Mission
contracts.
critical, can't rip it out, can't live without it.
Exactly. Right. So that doesn't exist in cosmetics quite as much, but there's definitely ways to look at revenue quality. And so like one of the things I learned from the M&A markets is actually they valued pro channels like spas and estheticians and even medical applications as much stickier revenue. And that's true. It just is. And so it's harder to get into, but it is stickier revenue, so of a higher revenue quality. And so that's actually been, so retail itself is obviously where you can achieve exceptional scale, in a very short period of time. But for us, there's just a big fear of like, it's relatively easy to test retail. It's hard to sell through. So like the kind of hard is selling through. And so like, if I look throughout our org, I'm like, who here is the expert? We're not, I want to be someday, but we're not that expert today of how to drive sell-through in cosmetics and retail. And so knowing that that's the hard thing, I went after pro channels first. And so that's been what we've been pushing over the last, 12 months plus. And we're really starting to get some significant traction in those channels. And there's also quite a bit of scale that's accessible through that. In the cosmetics market, there's still a, multi-billion-dollar TAM in the pro channel for even just domestic.
And how did you, I guess, A, get up the learning curve, and B, execute the distribution? Yeah.
And it's definitely learning curve more than the execution, because the execution is not terribly difficult from a fulfillment standpoint. They're glorified large DTC orders, like it's $1,000 order that comes in. You could do that all day out of the same fulfillment center. And so, it is more around the positioning, how you find them, how you approach them. Positioning has been the biggest learning of like, what do they care about? How do we make it unique to them? Because ultimately your customer changes. You think of the end customer, but in this case, my immediate customer is that pro, that esthetician, that practitioner, I should say.
You're not putting them through a quiz.
Right, exactly. And so all of that like mastery of selling an end product to be consumed at home is different than like I'm selling, really the main pitch becomes like your service. And then ultimately I want it to appeal to the end customer. So it's a reorientation. And I would say we learned a lot in that space mostly through failing, show up to the shows. What's the pushback you get? Talk to the customers. I mean, it's classic dog food, like eat the dog food, talk to the customers and learn. But then the other way, it's funny. I read this in like a Michael Lewis book. And it just sort of stuck with me. I think it's the book about high frequency trading, and in the Wall Street firms are like trying to figure out what's going on. And then he goes, whenever Wall Street needs to figure out what's going on, they post a job listing and they interview people. Why? Because under the auspices of a job listing, people are going to sit there and brag, and they're going to tell you all their accomplishments and how they did it and how they're going to make you $100 million by hiring them, right? And so Wall Street does it all the time. So why don't I? And so like, it's not to say that we're disingenuous with the hiring process, but you learn so much by just talking to people and what are the concerns they have with how to come in and succeed. What is it they want to see in an org? What are the questions they're asking not just you asking them. And so you learn so much by just doing that, trying to hire for the role. And so we're still going through some of that hiring process, but we learned a ton talking to customers and then ultimately talking to people who we want to scale the sales side of the business.
Today, I want to tell you about More Staffing, a group that we use to help us hire top-tier talent from the Philippines. Now, V1 of offshoring was hiring VAs, doing basic data entry work or administrative tasks. V2 is much more upskilled labor, folks that have been experienced for several years, up to 15 years, doing highly technical things, creative things, or in our case, hiring for supply chain managers and product development folks in the same time zone out of the Philippines as our manufacturers who are in China and Vietnam. More Staffing has deep expertise placing supply chain managers who have worked with Western brands, including many CPG and DTC startups, help run supply chain end to end. We love working with them. We've had several folks placed by them. Morestaffing.co. Go and check it out. Dave, since you brought up revenue quality earlier, I think it's a great nuance to add to the M&A conversation. You've bought brands, you've sold brands, you run a sales process for Bamboo Earth. I think most of the market today knows that in the emerging brand space and the sub $50 million revenue space, things really trade on an EBIT basis, not a revenue basis. I think that that's now mostly commonly accepted. But to go a click deeper, like there are there are value drivers beyond just, hey, give me the biggest EBIT number. You touched on a couple of them. I'd love for you to talk about that.
Yeah, I think that's a really good insight. And so some of my takeaway from the M&A space is that they value certain things from an attribute perspective, and I should listen to that because that's at least sample size of one, me talking to the market, here's what they value. And it was really interesting to get that level of feedback. And so there were a few pieces that came back and it's like, so revenue quality, like we talked about, that's something that people think about. And so I look at Bamboo Earth, it's like, good. At least half of our revenue quality is repeat customers. That's much more predictable. I've even made a course about how you predict exactly that, right? Like, so it is pretty predictable from a, inputs to outputs perspective and sustainable through things like drops and performance on the acquisition side. We all know that paid social acquisition revenue is probably the most volatile form of revenue out there, right? And so what were the other pieces that they valued? And so I mentioned like the pro space was something they valued, subscription is something they valued. And so that's also what led me to membership and moving our subscription numbers up, not just repeat revenue, but it's automatically recurring. I wouldn't say these are things that got huge multiples, but they're things that like raised eyebrows and made them more interested when you had good numbers on, made them less interested when you had poor numbers on. Something that I found out was extremely high unique repeat rates is something very, very valued especially by strategic acquirers. I found out that cosmetics and beauty generally doesn't get that high, that usually it has to be like with a daily CPG type thing, like deodorant can get to 60, 70% unique of customers repeating on that type of stuff. So there are some product categories that can typically do that and they'll command better multiples because there's real loyalty baked in there. And And so like in a way, your customer file and its likelihood to purchase is sort of a balance sheet item that is unseen. It is a value or an asset to the business that then gets valued by that acquirer. And so I think about that, pretty consistently. How valuable is that asset that I hold? Am I making sure I'm protecting my active customer file, my subscription file? Am I growing it? Is my product roadmap, growing that? Another piece that I think is always interesting in the M&A markets is like, it's funny that like the theoretical value of everything is the net present value, the future cash flows, and nowhere in that actually even says profit or EBIT, right? And it's funny because we all use profit or EBIT as a proxy for that future cash flow, but that's where I think the net working capital plays into things. And I'm sitting here saying, well, you can actually realize my cash flows in a lot more material way than a brand that is, has a good amount of leverage, is turning goods dramatically slower, has more exposure to changes in supply chain or, financing or what have you. And I think that isn't, I don't think we have widely as a group of DTC processed that well enough, because I do think that impacts we've seen that in the public markets as well as private, but there's real stability in cash. So yeah, I would say that's another one that I'd learned along the way.
Yeah. Dave bring deep institutional expertise doing NPV calcs that I don't think anyone in the SMB or kind of emerging brand space has done. But I think, yeah, spot on. As we head to a wrap here, what's got you most excited for 2025, whether it's tech or tactic, channel, product, anything?
Yeah, I think it's product and distribution channel. So for us growing the pro channel, that's like the primary thrust. And that's actually the two priorities for the business are product and expanding that distribution channel. And so when I go back to product, it was really both. In some ways, it's also like trying to like kill my darlings. Like, I do think that we've been stagnant in a couple ways. And I look at everything through the lens, at least for direct to consumer, through the lens of like, I'm going to try to sell them a routine. And so I'm now consistently trying to increase the value of that routine that I sell them. And what I mean by that is like, I sell them one piece that I think this is a $40-something product. I think it's relatively low efficacy, low, comparatively, low perceived value from the customer, et cetera, but it's an important step in the routine. Okay, well, how do I re-engineer that so that it is high perceived value, high efficacy, high, return on their investment? And so in that sense, I'm also just looking at, there are some of these products where I'm definitely going to kill their volume, replace it with something, but part of that is in service of a better experience, higher valued experience, et cetera. As well as something just totally net new to talk about. But I really think that from a product perspective, this is like kind of a rebirth of the brand at 2.0, that I think that at the end of the day, that's what we're here to do as product businesses, is innovate, drive value through our product into the market. And sometimes we lose sight of that with all the complicated in between. But I think that that's something we have really clear vision for over the next 12 months. And I'm super excited about that.
Dave, super appreciate the time. Where should people find you? Is there anything you want from the universe, anything you want from our listeners to come and check out?
I want you all to sign up for a membership at bainworth.com, start consuming our products, start looking beautiful, start consuming all my skincare. You can also find me on X or Twitter or LinkedIn, follow me, but really just go buy skincare. That's the primary ask here.
Dave, this was such a great conversation. Really appreciate you coming on and look forward to next time.
Thanks, fam. Thanks for having me.
Thanks for tuning into the show with David Rico. I think it's one of the best shows we've done. He's just so strong tactically on all things marketing, finance, and operations. We're super keen and open to feedback on what you'd like to hear from us. DM, comment, Twitter, LinkedIn. We'd love to hear from you, the type of guests that you'd like to have on, types of topics. Thanks again for joining us, and look forward to having you on the next one.